Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as I go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, see what people are sharing. And if you want to find me on Twitter, it's at @finance, and you can join our community, finding-value.com, where I dive deeper into all of these topics, looking for potential investment opportunities and sharing those opportunities with everyone in the community, and obviously letting you guys know why I like them or not. We recently just had a Q&A session where we went through some of the conference calls of what I thought were some of the highlights in some of the calls that I listened to, so you guys can stay up to date and you don't have to go through all the conference calls yourself. If you want to join, we do have a coupon code special, which is the coupon code. If you'd like to join, it's 50% off the monthly membership and a larger discount on the yearly membership. And you can always swap from a monthly to a yearly if you're interested. We're going to start with some quotes here. Invest in preparedness, not in prediction, says Nassim. And I know a lot of people on YouTube are making a lot of predictions. They make a prediction and have a price target. My price target is $6,500 S&P 500 this year. It's going to be over $40 an ounce of silver by X date. That's not necessarily how you make money in the market. Um, what a lot of successful investors who haven't lost their ASS, what they do is they buy things that are cheap and are undervalued. Then they wait for the market conditions to come back into cycle, and then when that cycle comes back into play, the investments that they made go from undervalued to fairly or overvalued. Sometimes those investors will sell it when it's overvalued. Other times they'll just ride it through a bunch of different cycles as long as the long-term prospects of the company look good and the fundamentals of the company and business look really good. So the really good investors, they don't focus on predictions. They focus on preparedness and being ready to buy when things are cheap. Charlie Munger says, opportunity comes to the prepared mind. Opportunity comes to the prepared mind. Here's one from Warren Buffett. He says, we derive no comfort because important people, vocal people, or great numbers of people agree with us, nor do we derive comfort if they don't. A public opinion poll is no substitute for thought. I completely agree. 100% completely agree. Oftentimes, I think different than a lot of other people, right, wrong, or indifferent. I might have different reasons, different approach, different ways of looking at problems and solving problems. And sometimes the best question sometimes is, do we even need to solve the problem? Um, at work, there was all these, it's like they put up walls and try to climb over walls constantly. And they're like, how the heck do you get this all done so fast? I said, well, I don't climb any of the walls. I just go around them. Like, there's no point in climbing these walls, guys. There's no point. You could just go right around them. And some of these things aren't even problems. Like, you're worrying about things that aren't problems. So, yeah, I was in a trading session. I mean, just to give you guys an example, I was in a trading session, and we were going through this activity where you're supposed to rank these items of their usefulness after a plane crash. And there's a bunch of things like a mirror, a gun, salt, water, stuff like that, parachute. And I ranked them, and the way that I ranked them, my strategy, and I'm not a survivor. I didn't go through Cub Scouts or anything like that. I just said, well, I'm not going to be walking any sort of distance in the desert because it was in the desert. So I just did everything based off of how to flag someone down. So like a mirror, there was a coat, and some other things. I was like, well, you could protect yourself from the sun, use it for shade. There's all these different things. And we went individually, we went groups. It's supposed to be lower in groups, but I actually ended up at the lowest score, even better than all of the groups in the class. Not trying to brag, there's part luck to it too. But even even when you go in groups and try to get the public opinion poll, it doesn't necessarily mean that having more minds is better. You want the right minds with the right skill sets and the right way to approach problems. Here's Logan. Logan says, reading is essential. The history of human civilization demonstrates that those who can read and write always have an advantage over those who cannot. The anti-central bank movement originated from a cult-like mindset. Read books, don't burn them. Total balance by delinquency status is super low. It's barely climbing. And this is single-family residence loan delinquency rate is now higher than that of 2008. Real estate crash has begun. But it hasn't, because these people are stupid. They have no idea what they're looking at. This is the data here. It's not anywhere near 2008 or 9. I am close. Uranium Insider. Let's talk uranium. So Justin Hune says, I can tell you with a straight face that many utilities, when prompted about their concern or lack thereof about a future uranium shortage, believe of one of two things. Eventually, sput pounds will shake out, or Arrow will be producing almost 30 million pounds per year 3 years from now. Concerning the supply deficit late decade, early 2030s, Arrow is the linchpin. Yes, Kazatomprom will ramp, but 6 and 7 from 3.5 million pounds this year to 15 million pounds per year by 28-29. But half of that goes to Russia to fuel their massive export business. The other half won't even buffer the steep production decline of the majority of KAP's remaining projects that start early 2030s. Back to Arrow. It will be a mine, but if history is any indicator, optimistic timelines that only utilities believe will shock the industry and supply story, but should come as no surprise to investors. If you model out an optimistic supply scenario, we have any delays in any projects, especially Arrow, will result in persisting deficits, more valuable commercial inventories, and much higher prices. So that is his opinion. Now, there's something going on here. I'm just going to touch on Arrow's project here. It says uranium commentary on the Supreme Court ruling against the Saskatchewan government in favor of the METIS, mostly AI analysis. I guess this is an indigenous group. NexGen's uranium future is in doubt. Court ruling threatens delays and price spikes. So February 28th, 2025, the Supreme Court of Canada ruled against Saskatchewan letting Metis Nation Saskatchewan MNS challenge NexGen Energy's 2021 uranium permits. MNS says the province didn't consult them properly about NexGen's Rook 1 project in northwest Saskatchewan. This decision could delay the mine, rattle NexGen's finances, and push uranium prices up. Here's at what's stake. The ruling, a win for Indigenous rights. So there's something going on. I'm not going to go through all of this and jump into each item. But right now, there might not be a clear path for NexGen to produce quickly. There might be some resistance between producing from these assets and maybe some litigation here going on. Charlie Munger, here's another quote. It says, figure out what you don't want and avoid it, and you'll get what you do want. There's a lot of truth to that. So you can look at a bunch of different sectors. You can look at the companies. You can look at how leveraged they are in terms of their balance sheets. And then if you just pare down what you don't want, a lot of it falls off the plate. A lot of it. There's a lot of crap out there, guys. There's a lot of crap. And then you kind of cut and dice the crap away and you look for, let's say you're looking for infrastructure and cash flow and all that stuff. You'll be led to a few sectors in commodities that are ridiculous. Brandon Balo says silver investors focus on the long-term picture here. Silver to the S&P 500 ratio chart tells the story. We're coiling up and potentially ready to break out where silver starts to outperform the S&P 500. And this is SIL, that's actually the SIL ETF, SIL. He says silver, but I think that's an ETF. Delinquency rate on single-family mortgages. Okay, I went over that before. There's something I want to read to everybody. So this is the key to market returns is time and not timing. This is by Bill Miller. He is a investor, and he wrote this piece, and I kind of want to go over it. We were talking a little bit about it in the Q&A session. So I kind of want to just go over this real quick. I'm going to read it, obviously. So Bill Miller recently discussed the state of the market, offering insights into how the team thinks about opportunity. This is a recap of the main points of that discussion. So if you haven't read Bill Miller's quarter one, quarter two letters, it's a good place to start as a setup for recent comments on the market here. So Bill makes the point that people have been expecting a bad macroeconomic environment, and the main reason for that has been the inverted yield curve. While an inverted yield curve has been villainized as a predictor for a recession, Bill suggests that investors take a closer look at understanding why the yield curve inverts and what it actually means. So he offers this. There is no fundamental linkage between an inverted yield curve and a recession. None whatsoever. The only thing that an inverted yield curve means is that the bond market's expectation for the so-called neutral rate of interest, which is the rate of interest that the Fed sets, which will neither stimulate nor put downward pressure on the economy, is lower than it is today. He points out that the 5.5% on the upper bound of the Fed funds rate is significantly above where it has been for the past 20 years, and that we're coming off a unique period in history where record amounts of money were printed, stimulating the economy in a significant way. The Fed's inflation goal continues to be 2%. Policymakers know more today than ever. There will inevitably be panics in the future, but the more we understand the system, the better we are able to operate within it, including managing interest rates. One challenge to operating in markets is the vast amount of information. Where do investors focus their attention, their time? Right now, many macro thinkers are focused on the inverted yield curve. They aren't paying attention to other powerful signs in the markets, like home builders breaking out, strong mortgage rates, and consumer demand for new housing. Holy crap, this guy must do exactly what I look at, because those are the leading indicators. Home builders, mortgage rates, and consumer demand for new housing. That's generally been the driver of these boom-bust cycles. And I'm surprised that Bill Miller knows exactly where the cycle is at. So it's good. He says, the key to returns in the market is time, not timing. This is central to our philosophy as long-term investors. You have to not only believe this, but also put it into practice to influence how you think about information. Let me read that one more time. All right. The key to returns in the market is time and not timing. Timing is what everyone is trying to do with a lot of the technical analysis. Now, I do that to some degree on the long-term charting to find entry points. But then I sit in it and I'm patient. He says, this is central to our philosophy as long-term investors. You have to not only believe this, but also put it into practice to influence how you think about information. We're not trying to predict where the economy is going and then look for bets within a forecast. Forecasts and predictions are too often wrong. As Bill Miller states on the call, a lot of people in the market try to use the economy and their view of the economy to determine where the market is going. And that's exactly backwards because the economy does not predict the market. The market predicts the economy. The market is people who have real money at risk, and the totality of that is how the market acts. Bill explains that at MVP, we are looking at what the market has already priced in. We're trying to understand the expectations for the future cash flows of a business. We're picking businesses to invest in that we believe will deliver over the long term. So where does that leave us today? We think small caps and lower valuation securities are compelling. Dan List gives evidence on the call. Here's the clip. He says, overall, the takeaway from the call is that we see opportunities in this market and we are going to actively manage our portfolios to navigate a constantly changing environment. Our goal is to continue to offer not only compelling investment strategies that add value to our investors' portfolio, but also to share how we're thinking about the environment and why we are investing the way we do. In the Q&A at the end of the call, we received a question about the importance of management teams in a research process. Bill explained that it's one of the most important things we consider. We pay attention to what management's saying and what they're thinking, and whether or not they're actually acting in alignment with what they're saying and doing, and whether or not that's actually generating true economic value for us. The same goes for how we approach what we do for our investors. And as the largest investors in our own strategies, we hold ourselves accountable every day for our thoughts and actions as investment professionals. And I agree with that approach. That's the approach that I have adopted. My approach is taking long-term investment view, finding things that are undervalued, and then looking at those undervalued investments to see what type of growth out in the future there is. And if the market has, in my opinion, accurately looked at the future growth and is pricing it accurately. The best time to buy is generally when sentiment is negative in your investments. Perhaps it's a slowdown in the market and people are selling those shares because of a air pocket of a slowdown. And there are sectors that are doing that right now that I think offer good risk-reward opportunities. And what I'm doing is in these Q&A conference calls, I'm going over those opportunities with you guys, and I'm showing you what I look for and why I think they're opportunities and why they might be getting sold off in the short term. But that's where I'm going to end it, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. Special coupon code. And we'll see you guys next time. This is Finding Value.